A lot of crazy stuff has been happening the past few weeks. Things were going reasonably well, stocks were hitting all time highs, then one day the US and Israel launched a massive military strike on Iran. The Strait of Hormuz, which has 20% of the world's oil supply running through it, is suddenly shut. Oil prices spiked, bond yields jumped, and everything else started to drop. I mean, we don't know which direction things will continue to go now that things supposedly are easing up, but at the current low of the sell-off, the S&P 500 alone dropped about 8% in the span of a month. In a time where everyone is panic selling, you probably start thinking if you need to pull out and find something safer, because if oil prices continue to remain high and war continues, everyone's holdings will continue to dwindle. But here's the problem. What even is safe right now? Normally in times of crisis, there's a general idea of what to fall back on when the market takes a tumble. Stocks go down, you buy bonds. The dollar weakens, you buy gold or silver. War breaks out, you look into buying treasuries. However, in more recent times, every single one of those traditional safe havens started behaving in ways nobody expected. Many people bought these assets in uncertain times thinking it would protect them, and it did the exact opposite. So what actually qualifies as a safe asset then? What would protect you against all the uncertainties in the world, especially with how volatile the market fluctuates in this administration? Also, where's all this money that got pulled out actually going into now? This isn't financial advice, by the way, but it should give you a much more broader outlook of how you might view finance and investing. Before we talk about specific assets, we need to define what a safe asset really means, because safe means different things for different investors. For some people, it means not losing the amount of money they put in. For others, it means this asset fights against inflation. For others, it means that the value will continue to go up while everything else is crashing. These are genuinely different goals and mindsets, which often require different assets. An asset that protects you from a market crash might get destroyed by inflation. An asset that beats inflation might be highly volatile. There is no single asset that solves every risk at once. That being said, there are a lot of variables to consider, but a true safe haven should hold its value or rise specifically during periods when equities are selling off. Let's go through the different major asset classes and see what the data actually says. For most of the last 50 years, US Treasury bonds were considered the safest investment globally. When markets crashed, investors fled to treasuries. Yields fell, prices rose, and bondholders were rewarded for their caution. Short-term treasury bills currently yield around 3.5 to 4.5% return. They're exempt from state and local taxes, they're liquid, and they're backed by the full faith and credit of the US government, which there has been some worry about, but historically speaking, there should not be any worry about treasuries. But here's the most important caveat. Long-duration treasuries, the 10-year and 30-year bonds, have become increasingly unpredictable and have weakened significantly since 2022. The federal government has issued roughly $2.3 trillion in new debt annually since 2020, while the US sovereign credit rating has been downgraded in May 2025. So to take it into more recent events, when stocks sold off around the Iran war, bond yields jumped instead of falling, meaning bond prices fell at the same time as equities. That's the opposite of what you would want a safe and reliable asset to do. Another asset is gold, and in recent years, it has been on an extraordinary run. Just in 2025 alone, gold surged approximately 57%. Data from some sources shows gold has outperformed US stocks, bonds, and treasuries over the last 25 years on a total return basis. Gold prices are consolidating in the $4,000 to $4,500 range in 2026. With a good probability of gold reaching $5,000 per ounce if ETF flows remain strong and central bank demand holds. Crucially, gold has demonstrated consistently low correlation to other major asset classes. A portfolio adding 20% gold allocation with the 60-20-20 model, which is 60% stocks, 20% gold, and 20% bonds, delivered roughly a 7.5% annualized return. That being said, gold is not a perfect hedge. During the peak Iran war panic in March 2026, gold initially surged but then fell very sharply, dropping as much as 17% in 1 month as investors worried that energy-driven inflation would force higher interest rates, which erode gold's appeal as a non-yielding asset. The next asset is money market funds. This is where the biggest flow of scared money and panic sellers have gone, and for understandable reasons. They hold short-term, highly liquid assets, treasury bills, short-term government debt, and commercial paper. They aim to maintain a stable $1 per share value. They're not that exciting and well known, but they currently yield around 4 to 5% and they have pretty low risk. Total money market fund assets hit $8.2 trillion at the end of Q4 2025, according to the Federal Reserve, which is up roughly $848 billion or 11.8% over the course of 2025 alone. The Investment Association found that the short-term money market funds were the single best fund sector of 2025, with record inflows throughout the year as investors sought defensive positions during geopolitical and policy uncertainty. Next, I want to talk about an asset that most people were probably expecting: real estate. Housing has historically been a strong inflation hedge and a source of stable long returns. The S&P Case-Shiller Index has shown U.S. home prices appreciate at roughly 4 to 5% annually over longer periods, and real estate generates ongoing rental income on top of that. The problem with this, though, in 2025 and 2026, home prices have gotten so high and have elevated mortgage rates. With a 10-year treasury yield hovering above 4%, mortgage rates remain high, suppressing home prices in rate-sensitive markets and reducing affordability for new buyers. Deloitte identified housing as one of the persistent weak spots in the 2026 economic outlook, with residential investment dragging on GDP growth throughout 2025. Real estate investment trusts, or REITs, offer a more liquid way to get real estate exposure without buying a physical property. Historically, REITs have returned around 9 to 10% annually over longer periods of time, comparable to equities but with better income characteristics. Finally, there's the classic very low risk and somewhat decent gains. We have high yield savings accounts and short-term certificate of deposits. For money you still might need in the next 1 to 3 years, they are genuinely attractive at this point in time. With rates still elevated from the Fed's 2022 to 2024 tightening cycle, certain accounts were offering around 4.5% annual rates as of early March 2026, while having no lockup timeframe. Now let's talk about what's happening right now, and why it's made this question so hard to answer. In early March 2026, the US and Israel launched what's called Operation Epic Fury, which was a massive military strike on Iran. Iran retaliated, hitting US military bases and neighboring Gulf states with missile and drone attacks. Iran's leadership vowed to keep the Strait of Hormuz shut down. This caused oil prices to soar. Brent crude surged past $112 per barrel at its peak, which were levels we have not seen since 2022. And what happened to the safer assets we talked about earlier? According to TrustNet, more than 95% of all investment funds lost money in the 2 weeks following the outbreak of the conflict. The Dow fell for 4 consecutive weeks, its longest streak of weekly losses in 3 years. The S&P 500 dropped roughly 8% from its late January record high. The Nasdaq entered a correction territory, down more than 10% from peak. And gold, which initially rallied 40%, reversed sharply, falling nearly 17% in 1 month. That was gold's worst monthly performance since October 2008. Bonds weren't a refuge either. Treasury yields jumped sharply as investors sold bonds and repriced expectations for inflation and rate cuts. The 10-year yield hit 4.39%, its highest level since July 2025. With the Trump administration simultaneously seeking $200 billion to fund the war, adding to government deficit concerns, which made holding government debt not as attractive. The market had initially assumed the Iran war would be short. As it became clear it wouldn't be, the dynamics shifted from safety into broad liquidation. When everything is uncertain, people don't just buy safe assets, they hold cash. The two sectors that actually made money during the initial sell-off, energy, obviously as oil price spiked, and cybersecurity, as investors bet that hybrid warfare would drive demand for digital defense. That's not typical safe assets though, that's trading through a crisis. So let's talk about what normal investors actually did when the panic set. They sold, and it was not a small amount. The Investment Association reported that investors pulled £16.8 billion out of equity funds over the course of 2025 in the UK alone, driven by concerns about overvalued US tech stocks, AI bubble fears, and geopolitical uncertainty. In the US, market observers tracked massive rotations out of equities, particularly out of the international and emerging market funds. Reuters reported that following the outbreak of the Iran war, $21 billion had poured into emerging market debt in just the first 2 months of 2026. And then those flows reversed sharply as the conflict dragged on and the stagflation narrative took hold. Money that had been moved toward risk was being taken back out. So where did all that money actually go? Primarily, it went into 3 places. First, into money market funds. As covered earlier, These assets have been at or near all-time highs throughout this entire period. When stocks sold off in April 2025 during the tariff shock, and when volatility index spiked to 52.3, its highest level in years, it was reported that inflows into money market funds surged over $51 billion in a single week, hitting $7.03 trillion for the first time ever. By the end of 2025, money market fund assets were at $8.04 trillion. By mid-March 2026, during the Iran war panic, they were at $7.86 trillion and rising again. The second one was short-term treasuries. While long-duration bonds were getting sold, short-dated treasury bills remained a top choice. What was the appeal? Like I mentioned before, higher yields than savings accounts, exempt from state and local taxes, and also being backed by the government. The third one was cash and high-yield savings accounts. Total bank deposits in the US stand near $20 trillion. For retail investors especially, the simplest move was to hit pause and park money in savings accounts offering 4 to 5%, a really good option that didn't exist when rates were near zero. With rates above 3%, the rotation to cash-like instruments was rational given the current environment. Here's the hard truth about all this though. Some of those people who sold stocks and went to cash during the peak of the Iran war panic made a mistake that they don't even know they made yet. History tells a consistent story on this. Hartford Funds data shows that if you miss just the 10 best trading days in the S&P 500 over a 30-year period, your returns would be cut in half. Miss the best 30 days, returns shrink by 83%. And 78% of the stock market's best days have occurred during bear markets or the first 2 months of a bull market, exactly when scared investors are panic selling. So, to sum this all up, the honest answer is that the old safe way to invest has shifted slightly. The traditional positive correlation between stocks falling and treasuries rising has broken down. Morningstar analysts noted that we may be experiencing a permanent shift in long-held assumptions about asset allocation. That's not a small statement coming from those institutions. Here's how assets actually stack up in the current environment. Short-term treasuries with 3 to 12 month maturities are still solid, with yields of 3.5 to 4.5% being government-backed, liquid, and tax-advantaged. Is the best for capital preservation over 1 to 2 years. Not great for long-term wealth building, but genuinely safe for near-term cash needs. For gold, it is strong long-term, but short-term is extremely volatile. With huge gains since 2022, an excellent 25-year track record versus stocks and bonds, low correlation to equities makes it a real diversifier. A projection of $4,000 to $4,500 per ounce for 2026, with an upside scenario of $5,000 plus. But it does have sharp corrections. Gold fell 17% in a single month during the Iran war panic, so it's generally best to be 10 to 20% of a portfolio, but not a 100% position. For money market funds, it is safe, but you understand the trade-off. Currently yielding 4 to 5%, is fully liquid and has stable value, is perfect for cash when you might need it within 12 months. The risk, though, is opportunity costs. These assets grew $848 billion in 2025, but the S&P 500 was still up roughly 13% that same year despite all the volatility. Holding too much in these assets for too long is its own kind of loss. For diversified index funds such as the S&P 500, it is generally safe over the long horizons but not for the short term. Historically, it has had 10% average annual returns since 1926, but you have to stay in. The investors who sold during the 2025 tariff shock and the 2026 Iran war panic likely locked in losses that would have recovered later down the line. For real estate and REITs, it is a solid inflation hedge but is interest rate sensitive. Overall, it has long-term appreciation of 4 to 5% annually plus rental income or REIT dividends. REITs historically return 9 to 10% over longer periods. But in a high interest rate environment, this asset class is under pressure, which makes it best suited for long-term investors who don't need liquidity. So what is a safe asset right now? Unfortunately, there's not a simple and clear answer to that question. Life and markets are too unpredictable to really give a solid answer. What we do know is the data. Short-term treasuries remain the best option for capital you can't afford to lose in the next 1 to 2 years. Gold has earned its place as a long-term portfolio diversifier, but 17% drop in a single month during the Iran war panic is a reminder that nothing is crisis-proof at every moment. Money market funds are where trillions of dollars fled during the uncertainty of 2025 and 2026, with the yields being pretty good right now, but staying in cash too long has its own cost. And finally, the stock market, despite everything, is still the best long-term compounder of wealth that has ever existed, provided that you stay in for the long run. The lesson here is that there will always be investors that sell during panic, and they will most likely end up selling at the bottom. During the April 2025 tariff shock, during the Iran war panic, they didn't lose because they picked the wrong asset, they lost because they let fear override the math and statistics. The people who get through this the best are those who plan for it before it even happened, by being diversified, patient, and not reacting to every single headline. If you found this breakdown useful, please consider leaving a like and subscribing. I'll see you guys in the next one.